So today's video is about asset location strategies utilizing our model portfolios. Today we're going to take a look at a hypothetical client. We've got John and Jane Smith. Our first page here, we have a statement of net worth. So we can see John's traditional IRA is worth $1 million. They have a joint brokerage account also worth $1 million. Jane's traditional IRA is worth $750,000 and her Roth is worth $250,000. So our total household investable assets are $3 million. So let's jump ahead and take a look at some of their profile data. Here we can see that John is 65 and Jane is 63. John has a salary of $275,000. Jane's salary is $350,000. They are looking to retire presently, right about now, or maybe sometime in the next few years. And I think we'll just jump ahead from here. We won't bother walking through the rest of this page because we will see it here on our results page. So you've gone ahead and you've put together a rough draft or a first draft of a recommendation for these prospective clients, and now you're going through the results. And what we can see here is your plan that you are recommending is scoring an 88, right to the top end of the target zone. So this is a good place to start. We do have the clients just go ahead and they can retire now if they wish. And that is with the following assumptions: $120,000 a year in base case retirement spending for the rest of their lives. And then we've split out a couple of special spending items. We have a travel budget. I call this the golden years travel budget. We've got it going from retirement to age 75. You know, we're not saying they have to stop necessarily at 75, but we find that there's more value in having some additional spending for things like this when you're younger and healthier. We have annual gifting to their children, $38,000 a year. We're going to do that from retirement to the end of life. They want to renovate their cottage sometime in the next year now that they have time to get to it since they're retired. So we've carved out a one-time spending item, $50,000. And then we have an in-home care budget for the last few years of life for the second to die spouse. Okay, $75,000 a year for that item. We have some other income sources besides investment withdrawals. We have a CRIP, a Kodak pension, that is $24,000 a year. And then there's a survivor benefit of $18,000 a year. I think that's 75% survivor spousal benefit. And now we have Social Security. We're going to go ahead and defer Social Security until age 70. You know, this is often a good starting point because it leaves you room in your brackets if you're looking to do something like 0% capital gains harvesting. We can always adjust later, but we'll start here with deferring to age 70. And then we also have an estate goal that does not include the value of real estate. This is an estate goal just coming from their investments of $1 million. This means the plan will look to draw down to $1 million when testing for the score rather than drawing down to 0. Okay, and we just have them starting out with what we call moderate growth in income, which in round number terms, we're going to call that your traditional 60-40 stock to bond ratio. Okay, so now let's talk about, we talked about asset allocation, right? Our 60-40 split. Now let's talk about asset location. Okay, so let's take a look at our target allocation is 60-40, which means that overall for the whole household, we want equities at about 1.8 million and fixed income at about 1.2 million. Okay. We're going to use a variety of our model portfolios to get the job done. So let's take a look at what their yields are These are backward-looking yields, obviously, but and they're, they could change over time. But looking backwards, the Equity Plus sleeve has a yield of about 1.29%. The Bond Plus sleeve, 4.3%. Our Income Plus sleeve, which is a blend of stocks and fixed income, is yielding 4.75%. And the Dividend Growth portfolio yields 2.4%. So with this information, what we're trying to do is make sure that while we want a total of 1.8 million in equities and 1.2 million in fixed income, we'd like to, as much as possible, tuck our fixed income exposure away into tax deferred accounts, right? Because if we can have models like this, the Equity Plus in brokerage account, yielding only 1.29%, and our fixed income or hybrid models that yield 4 or 5%, if we can have that dividend yield put into tax deferred accounts, we can help minimize our clients' tax burden. Okay, so how would we split up the dollars into equity and fixed income, considering the accounts and the values that we have for these particular clients? So let's start with John's traditional IRA, $1 million. We're going to have a target, and again, these are round numbers. Don't get hung up on exact numbers here. So approximately $315,000 in equity, $685,000 in fixed. This will give us an overall allocation of approximately 35% equities, 65% fixed income, and we are going to implement 20% in the Equity Plus sleeve, 50% in the Bond Plus sleeve, and 30% in the Income Plus sleeve to get the job done. In Jane's traditional IRA, similar situation. We've got $750,000 in total. About $235,000 will go into equities, $515,000 into fixed income. Again, this leads us to approximately 35-65 stock to bond ratio. Here, we're going to get the job done just with the two sleeves, 35% Equity Plus, 65% Bond Plus. Next, we have Jane's Roth. My face is covering up the value a little bit. It's $250,000. We have already allocated all of our fixed income exposure. So now we have the ability to go 100% equities in the Roth, which can be nice because either for them or their beneficiaries, having as much growth as possible in a Roth can be nice because the distributions later on are tax-free. Okay. So here we're going to achieve 100% equity exposure by allocating 70% to the dividend growth sleeve. And they had some interest in doing some things outside of our model. So we're going to also allocate 30% to non-program assets, $25,000 each into the Bitcoin ETF, NVIDIA, and Palantir. So they're going to take a little additional risk here with some speculative stocks and funds, or this is the Roth IRA. So if you're going to do that anywhere, this might be the most appropriate place to do it. And then in the brokerage account, again, we don't need any more fixed income exposure. We've managed to allow our taxable account to be 100% equities. Here, we're going to keep it simple and just go 100% Equity Plus. All right. So again, the household allocation, we were targeting 60-40. These are the total dollars into equity and fixed. We split it up in a variety of ways using a variety of our model portfolios. But in the end, we were able to keep all of the fixed income exposure tax sheltered in the traditional IRAs with these higher dividend yields. So mission accomplished. All right, let's take a look here. Now we have our allocation results for the household. Again, we're at about 60% equities, 40% fixed income. And jumping ahead here. Okay, here we have John's traditional IRA. You can see here that our asset allocation, very diversified between the three sleeves. You can see here our model holdings and their percentages. Okay, we've got the joint brokerage account. Again, here, this is a $1 million account, 100% equities here, and you can see we've got it in the Equity Plus sleeve. Jane's Traditional looks a lot like John's, right? We're using a combination of Equity Plus and Bond Plus. And lastly, we have our Roth IRA, where we have our individual stocks from the Dividend Growth sleeve. Okay, and we also have some non-program assets with our Bitcoin ETF, NVIDIA, and Palantir. Okay, so let's wrap things up here. So again, the idea here was to demonstrate how you can walk a prospective client through an Envision plan, and then from there, walk them through the implementation, where we are going to try our best to employ asset location strategies to help minimize their tax liability. Okay, now this is just a starting point. Don't get hung up on the details here. Every client is going to be a little bit different, and you might have to deviate from this, what I might call the sort of hypothetical perfect way to implement. You'll have to deviate because maybe, for instance, they want to keep 6 months worth of their cash needs in the brokerage account in a money market fund, or maybe they have some upcoming liabilities and you're going to do some liability matching with a bond or a CD. So generally, if you can shoot for this kind of an asset location strategy, but don't be afraid to deviate to meet your individual clients' needs, goals, and risk tolerance. So if you have any questions, feel free to reach out. If you're looking for some help on how to go through the same process with some of your clients, I'm always here and available. And I hope you found this video educational. Thank you so much.